Forget venture capital. Forget Wall Street. Forget the syndication bros on Instagram. What if the most powerful real estate empire you ever build starts with nothing but a house hack and a mediocre credit score? We're talking about scaling to 100 doors without a single hedge fund, family office, or institutional dollar touching your deal. The idea sounds almost illegal, like you're trying to sneak into a VIP section with a fake wristband, but people are actually doing it quietly, methodically, and without ringing a bell on CNBC. The catalyst here isn't some exotic new financial product. It's the boring, unsexy compounding of small decisions made consistently over years. Think of it like rolling a snowball down a hill. Your first duplex is barely a flurry, but somewhere around door 20 or 30, the physics start working in your favor. The macroeconomic backdrop of rising rents, housing undersupply, and a generation that can't afford to buy has ironically become the tailwind that small investors are riding without even realizing it. Now let's be honest, because 2 years ago, the headlines were screaming that real estate was the golden ticket, and then rates doubled and everyone suddenly became a real estate pessimist overnight. The investors who had conviction in the system, not just the market, kept buying, while the optimists turned into philosophers, asking whether property even makes sense anymore. The psychological weight of scaling without institutional backing is genuinely heavy, because every single deal feels like it comes out of your own chest cavity. But here's what the best operators quietly say. The constraint of using your own capital or creative financing actually makes you a better underwriter than someone writing checks from a fund. History doesn't lie. From the savings and loan crisis of the 1980s to the 2008 implosion to the rate shock of 2023, real estate has always had its villains and its plot twists. And yet, the landlords who survived each cycle weren't the most brilliant. They were the most boring, the ones who over-reserved cash flow and never fell in love with their own projections. Here's the beautiful irony of this whole conversation. Institutional capital, the very thing people assume you need to scale, is also the thing that introduces the most fragile leverage, the most misaligned incentives, and the most catastrophic downside when the music stops. Scaling to 100 units on your own forces you into a kind of discipline that a capital raise would actually let you avoid. People think the misconception is that you need millions to start, but the deeper misconception is that scaling means going bigger, faster, when it really means going deeper, smarter. 100 units built over 10 or 15 years using BRRRR strategies, seller financing, subject to acquisitions, and house hacking is not a fantasy. It's a documented playbook with real names attached to it. The actionable lesson here isn't to avoid all outside money forever. It's to delay it long enough that when you do raise capital, you actually know what you're doing with it. Your first 20 units are your tuition. Treat them like a laboratory, not a lottery ticket. Position size is everything in this game. And the investors who blow up aren't the ones who bought in the wrong market. They're the ones who concentrated too hard, too fast, with too little buffer. One bad eviction, one roof, one vacancy spike shouldn't threaten your entire portfolio. And building slowly without institutional pressure is exactly what creates that insulation. There's something almost poetic about the fact that the most scalable real estate businesses in America were built by regular people who just refuse to stop buying, refuse to stop learning, and refuse to confuse activity with progress. The process is the strategy, patience is the leverage, and consistency is the compounding force that no interest rate can permanently defeat. So here's the philosophical truth sitting underneath all of this. You don't need permission, you don't need a pitch deck, and you don't need a general partner to hand you a carry structure. You need a repeatable system and the emotional discipline to execute it when the market feels terrible. Discipline, sizing, and consistency aren't just words. They are literally the only three things that separate the people who make it to 100 units from the ones who stall at 5. If you're sitting at 0 units or 3 units or even 20, the path to 100 is less about capital and more about conviction in the process over the outcome. Be genuinely comfortable with a slower timeline, because the investors who try to sprint this race are usually the ones you see selling distressed portfolios at the bottom of a cycle. And the beautiful, almost absurd truth is that by the time you reach 100 doors without institutional money, you'll have built something far more defensible and far more yours than anything a fund could have handed you. Rational preparation, not reckless ambition, is what actually scales. Whether you're trying to buy your first property, find contractors to renovate it, or connect with lenders who understand the investor journey, check out the links in the description below. We can help you get started.